Thanks for joining us, viewers. This is Sage, your host, live from 𝐾𝐿 TV's studio in Sydney, and you're watching the Crypto Buzz. And in today's show, we'll tap into how the regulators are impacting the DeFi quadrant, as well as shine the spotlight on Solana and blockchain ETFs, as well as clarify the difference between crypto tokens and crypto coins. But wait, there's more. As the cherry on the sundae of today's special edition Crypto Buzz, we will also hear from the CEO and founder, as well as the CIO of Portal Asset Management, who operate a digital asset fund. So stick around. But firstly, let's head east for a better view of the plan to remove the use of cryptocurrencies in China by the Chinese authorities. Yin Yuping, the Deputy Director of the Financial Consumer Rights Protection Bureau of the People's Bank of China, has asserted that cryptos are another branch of speculative investment, and they're not sure if it was China's intention to send the US crypto miners flying to the moon and back with the surge in the revenue since the recent bans in China. But reportedly, the US Bitcoin miners have been raking in the returns since the prevention of mining of cryptocurrencies in China. The surge relates especially to the hosting space in the existing infrastructure of the digital investment ecosystem. The US miners take up a larger share of the Bitcoin hash rate. Riot Blockchain has experienced a 35% increase in mining revenue, reaching $31.5 million in the second quarter, and Bitfarms, another US mining firm, also saw an increase in market share from 1% up to 1.5% in the second quarter. Now, last week saw the expiration of the Bitcoin options contracts. Let's now take a quick look at the price of Bitcoin. From what we can see, the price of Bitcoin is still trying to find its path of least resistance to break out over the $50,000 resistant levels, which will support a bullish push forward. However, as the expiry of 1.8 billion Bitcoin options could be the reason the pullback was seen in the price of Bitcoin over the weekend, as it continues to stay in that sideways wedge at around $47,000 today, being 31st August 2021. Now over to its peer Ethereum, an ETH, the second most popular crypto by market cap. Price action is consolidating. We're noticing the highs getting higher and the lows getting higher, which are signs of a squeeze from both sides of the markets. And from these patterns, a breakout through bullish action could rally up to that psychological $3,500 to $3,600 levels. And since August 7th, ETH has not exceeded 3,391 or gone below 3,081. So what looks like a logical movement up will really depend on whether ETH will push past that $3,300 level. And however, if a bearish break for ETH heads into the nethers, we are looking towards the region of 3,018, which will test those lower levels of the existing band. And moving on, this week we can't talk about Ethereum without also making mention of Solana. Solana is gaining attention as a less time-intensive and more cost-effective alternative to Ethereum. The altcoin has seen some major institutional investment in its wormhole project of late, and the crypto community is expecting a shake-up of the investment ecosystem with the emergence of this on-chain multi-directional bridge, which will allow the transfer of platforms and projects using tokenized assets. Even more exciting is the battle for a Solana trust between Osprey Funds and Grayscale as they tussle with the Securities and Exchange Commission, or SEC, as to who will earn the gauntlet. But as always, the cryptocurrency space is highly volatile and does require careful analysis, as well as a clear outlook as to what your financial goals are and what your financial position is before making any major decisions. And it is advisable to not put all your funds into digital assets. Diversification in your investment portfolio can offer some form of buoyancy as the sinusoidal flux of the markets continue. And now it's time for a short break, but please do stay with us, as after the break we'll take a look at the difference between blockchain ETFs and the possibility of the emergence of a Bitcoin ETF. Property by 𝐾𝐿. Looking for a dream home? Well, that may sound easy, but it isn't. And from looking for a property that is the right fit for you in terms of cost and other factors, to zeroing down on the right mortgage plan, there are various aspects to consider.
And for the latest slowdown in the property market, tune in on 𝐊𝐿𝐴𝐚 TV with me, Sage. I will give the latest updates on the property market as well as real estate stocks to help you make the right decision. Keep watching Property with 𝐊𝐿𝐴𝐚.
Welcome back. Thanks so much for joining us. You're watching the Crypto Buzz and I'm your host, Sage, for 𝐊𝐿𝐴𝐚 TV. The virtual currencies have been the centre of multiple regulatory battles, and under the keen eye of scrutiny, this internet currency that has emerged from a mystical white paper and traditionally kept computer science majors chained to their desk with curiosity has a dark past in being a vehicle for criminal activities, especially money laundering. This could be the reason why the SEC, or the US Securities and Investment Commission's chairman, Mr. Gary Gensler, who is a crypto expert, has been hesitant to approve any of the enthusiastic Bitcoin ETF applications that have been lodged since 2018. Somehow, the cryptocurrencies have persevered, even cloaked under the veil of suspicion, providing users with a peer-to-peer transfer system that is decentralised from the traditional banking system. Maybe one convincing argument for the proliferation of this type of asset class is the fact that if everyone who has a bank account in the world was to ask for their money back at the same time, they wouldn't be able to get it back immediately, as the money has been loaned out in most cases. And that is the existing fiat system of money that we operate within, where a third party, namely the banks, manage our transactions of our money and charge us for doing so. As we attempt to weigh up the legitimate benefits of a decentralised monetary system, hyperinflation is another trickle-down effect of the existing fiat system, where countries like Venezuela are watching their peso decline in value every hour as their economy is hit with a deep recession. However, this last week also saw small protests from anti-Bitcoiners in El Salvador, where Bitcoin has been adopted as legal tender. However, the volatility of the sector and the fact that there is no underlying asset for cryptocurrencies does deter many investors or motivate them to find less volatile methods to gain exposure to the space. The last 12 months has seen a shift from some of the traditional asset classes, such as government bonds, and Cathy Wood of ARK Investments, who is an avid crypto investor, explained in an interview with Bloomberg TV that the government bonds have been on a 40-year secular decline in interest rates, which gives enough evidence to predict that government bonds as an asset class may be showing signs of fading. A good balance sheet for an investment company usually has 60% invested in equity and 40% in bonds, and this 40% can now also include investment in crypto instead of the government bonds. And even though Bitcoin futures are already offered on the country's two leading exchanges, cryptocurrency's regulatory status is still unclear in some jurisdictions, especially in the US, and the prospect of a Bitcoin ETF still remains a mirage in a desert on the conquest of digital asset investors. However, blockchain ETFs have been open for investment since 2018. So existing in the open and regulated markets now are 5 blockchain ETFs, and they are the Siren Nasdaq Next Gen Economy ETF, Capital Link Next Gen Protocol ETF, Amplify Transformational Data Sharing ETF, and the First Trust Index Innovative Transaction and Process ETF, as well as VanEck's Vectors Digital Transformation ETF. All of these ETFs were launched between 2018 and 2021. So what's the buzz? These ETFs earned masses of support even in the first 2 weeks of their launch, with $180 million of investor funds flowing into them. In April 2021, they had a combined $1.7 billion worth of assets under management, and their expense ratios ranged from 0.65% to 0.95%. So, what are blockchain ETFs? They are ETFs that hold baskets of stocks of corporations that invest directly in blockchain. So which came first, the chicken or the egg, or the blockchain or the Bitcoin? To put it in plain and simply for you, blockchain can exist without Bitcoin and Bitcoin can't exist without blockchain. So let's get some background on the development of this fairly new technological platform called blockchain. The blockchain, a system of ledger that operates in a decentralized framework upon which cryptocurrencies are layered, has been around only a fraction of the time of the internet, and it's being adopted as one of the inventions that could change life as we know it, like the radio, electricity and the internet. Although many have tried to launch Bitcoin ETF in the USA, none have yet to succeed due to the strict regulations that surround the space in the US. The first Bitcoin ETF application was lodged in 2013, and some firm believer on the search for this holy grail believe it's only a matter of time before one becomes active. Mr. Jay Clayton, the former chair of the US SEC, was not enthused by the prospects of a Bitcoin ETF due to the fact that it is open to price manipulation and that the US regulated markets has an extremely high level of protection that may not be offered in other world equity markets that may have previously accepted Bitcoin ETFs. Hopefully that's offered some sort of clarity for you on the difference between blockchain and Bitcoin ETFs. We've now reached the time for another short break, but stay with us for our final segment before we cut to our special guests, digital fund managers. Portal Asset Management will shed some light on the difference between crypto tokens and crypto coins.
Tune in to stay updated while on the move.
We will tell you where the crypto craze has reached,
Where the property market is headed next.
what the world is doing to become more environmentally friendly.
Apart from tracking the daily market charter.
Be on top of the latest news and announcements.
With 𝐊𝐴N TV.
Welcome back. Thanks for joining us, and you're watching Crypto Buzz, and I'm your host, Sage. Now let's try to remove the confusion which hovers around Bitcoin and blockchain. They are different, although the words are commonly used interchangeably. In short, crypto coins have limited utility compared to crypto tokens, and they're similarly confused in the way that Bitcoin and blockchain are. Crypto coins are a subset of crypto tokens. The functionality of tokens is wider than receipt and payment. They can even represent equity, smart contracts, security, or gaming benefits. Tokenization is the process of creating crypto tokens and allocating value to them. The crypto tokens, in essence, represent an existing digital or physical asset. Crypto tokens symbolize a set of rules, and every token belongs to the blockchain address. Any person who holds the private key for that blockchain address has access to that respective token, and that person is thus the owner or custodian of that crypto token. The custodian may or may not be the crypto token developer. However, it is the developers who have the right to publish their tokens on the cryptocurrency exchange. And every cryptocurrency token therefore represents a tradable good. The tradable commodities are coins, contracts, in-game items, a share in a company, or any voting rights. And due to this, few people refer to them as crypto assets or crypto equity. Tokens are created to provide security to the underlying assets. And this is why blockchain in the medical and energy industries is so exciting, as it could allow for more liquidity in the markets and also to monitor patients' healthcare and records more securely. In upcoming episodes, we'll investigate in more detail how blockchain is being used, creating opportunities on the electricity grid and in the investment into renewable energy resources, with Australian businesses playing leading roles in the adoption of this technology. So for a disruptive asset class, blockchain sure has the potential to open many portals and broaden our perspective about how our existing fiat system could be put into action in order to create more liquidity, and not just for those sitting at the top, but for all who participate in the blockchain. So what are you waiting for? Check it out if you can. And thank you for joining me on another edition of the Crypto Buzz, but stay with us as we'll now cross to our special guests, the digital fund managers from Portal Asset Management, CEO and founder Mr. Derek Graham and CIO Mr. Mark Whitten. Enjoy. So welcome to the show, Derek and Mark.
Oh, thank you very much, Sage.
𝐊𝐴N Media is excited to have you with us, and we're keen to hear your insights now, so let's get started. It's practically an endless summer for Portal Asset Management, being headquartered in Singapore with an office in the Cayman Islands and Perth, WA. How is Portal positioned to harness investors from the APAC region? Does this include retail investors as well as institutional investors, please?
Look, I think maybe first we might set a bit of context to the space, if that's okay, Sage. This space is now $2 trillion in capitalization. We consider it the fastest, possibly the most disruptive financial technology in history coming. And so we look at investing in the space, realizing there's 10,000 new tokens in the space, decentralized finance has come on board. There's nearly $80 billion of locked up value in decentralized finance, fully autonomous financial systems. And there's some 1.5 million users and $15 billion of capitalization in that alone. You know, we look at things like non-fungible tokens, which are methodologies of being able to tokenize anything from a concert ticket through to the biggest companies and office towers in the world by digitizing and fractionating and ultimately democratizing them. So when we look at this space, we look at in how to get coverage right across the space, and we do that in a manner which is at an institutional level. So our investors primarily are, family offices, small institutions, and high net worth individuals. And at this stage, therefore, we're not at retail stage.
Right. Thank you very much for giving us background there. And Portal had begun in 2019 and has introduced more than 700 digital fund managers over a short span of time. Can you please tell us more about your result-oriented investment analysis approach, please?
Sure, thank you. So there are a lot of funds out there. Not many of them have very long track records. So, part of the difficulty is filtering those funds to find what we call best-in-class fund managers. To that end, we've built a factor model that looks at their results objectively and quantitatively. So we try to understand how much risk they took to achieve the performance that they achieved, and then we do a full-on operational due diligence, qualitative due diligence. We assess all their service providers and so on. At the end of that process, we tend to have a really good understanding of every aspect of the funds that we look at. We've narrowed it down to around 50 funds that we follow globally. 25 we've done full due diligences on, and we've invested in 9 at the moment. We look to invest across, not only differentiated strategies, so we don't replicate any strategies. We also look to invest across volatility and duration, meaning that we invest across the very short-term time frame fund managers that are running market neutral and very low risk strategies, all the way to the fund managers that are running almost like VC type strategies, where that's less liquid and the volatility is much higher and the returns tend to be lumpier. I think in a nutshell, that's kind of how the investment process works.
Oh, fantastic. Thank you, Mark. That's the great segue to the next question, actually. And great to hear the diversified strategies that are used in the investment portfolios. So Portal's strategy has returned 46.1% with a target volatility of 15% year to date, current as of July this year, 2021. And Portal has returned 73.4% on average over the last 12 months, which actually exceeds your target of 25% return on investment. Now, this has gained the fund an award from Barclay Hedge, who have ranked Portal Asset Management number 3 in the world out of a possible 6,900 possible alternative investment funds. An incredibly impressive accolade. How does Portal maintain low volatility in a highly volatile space, please?
So it boils down to the correlation between the funds. So we look for funds that tend to perform very well when the market is rising, which is relatively easy. But then we also look for funds that give us downside protection, that perform very well when the market falls. So those funds tend to lose money in flat or rising conditions, and then make really good returns in down market conditions. Long volatility funds is what we call them. It's almost like having a parachute. So what we look to do is blend these fund managers, and we don't mind if they are high volatility, but we blend them in a way that their returns are not correlated. And that sometimes means that we come across a really good fund, but we can't include it in the portfolio because it's just too correlated with the overall market, or it doesn't add risk diversification benefits for the amount of return that's expected. So it's mostly through correlations and investing, as I mentioned earlier, across the different time duration sort of spectrum, across that continuum as well as across the volatility continuum, low, medium, and high risk funds. So, for example, in the market was really strong and rallying the first quarter of this year, and we tend to invest counter cyclically. So in around March, April, we started allocating more money and more funds to the very low risk funds in anticipation of potential pullback, which happened sooner and was more deep than we expected. And then at the bottom of that, when everyone is kind of in despair and there's just there's a lot of stress in the market, in July we'd be allocating back to the high volatility funds, because we have a long-term view. We're not really concerned about month-to-month performance. We have we look out 12 to 18 months and try and figure where the market's going to be then in terms of liquidity.
Exactly, and we've seen massive leaps and bounds from earlier this year. As you mentioned, the market was rallying while there was huge institutional investment into the cryptos, and people probably weren't expecting to be able to pay for their Starbucks coffee with cryptocurrency, but now they can. So the space is evolving at a great pace, as Derek mentioned earlier. And this digital fund sounds like a golden opportunity to gain exposure to the highly dynamic, fast developing yet complex ecosystem of the digital currencies. How does it differ to the blockchain ETFs that have recently emerged as well, please?
So to date, there's no actual blockchain ETFs. There's some proposed Bitcoin and Ethereum ETFs. There's one in Canada, and there's a few other funds that are offering you pure sort of exposure to Bitcoin, let's say naked long only type exposure. I think what we're looking to do is to say, look, we want to reduce the volatility of the space, which is 5 times as volatile as the equity markets. We want to reduce all your operational complexity, because the chain of custody in crypto is very different to the chain of custody in traditional equities. Whoever holds the keys actually controls the crypto. So your biggest risk in the space is actually operational risk. So what we do is we find these best in breed fund managers. We tend to look for managers that have a great pedigree, that have been managing money for at least 10 to 15, 20 years. But then we do a lot of risk mitigation in not only the way the portfolio is constructed, but also in how we manage our operations. We have a Cayman domiciled fund, Singapore-based investment manager. We're fully licensed, fully insured. There's third-party arm's length relationships in how we allocate the capital. So we take a lot of the operational and volatility and the stress out of investing in the space. That's one of the main fund management proposals.
Yes, it definitely should be a keen focus. Cybersecurity and those sort of cyber criminals can cause issues with cryptocurrencies, but we're finding that they are able to prevent the funds being transferred these days, in regards to what Tether did with the recent cryptocurrency hack that we heard of, the largest one in history actually, just recently. They were able to stop the money being transferred across from Polygon.
Right. I mean, what was intriguing with that is we actually saw the community come together. There's both technology and community in a manner which traditional institutions can't cope with. So what we saw is $611 million stolen. And within 24 hours, $324 million of it was returned because he couldn't access it. He couldn't do anything with it. There's knowledge of his wallet and who he was, not as a person, but as an entity. So you're able to track who that was. And so what he realized very quickly is that he couldn't spend his $611 million rather. And so accordingly, what had happened is a small part of it was a US dollar tether account, which was held back, as you've just mentioned. Large parts of it were sitting in exchanges that simply locked him up. And the time that the 15-day period from the 10th of August to the 25th of August finished, 611 was stolen and $611 million was returned. So it's an extraordinary thing when you see the actual community and the technology working together to see crimes like that not be able to come to fruition.
No, that's amazing. I think the community that's building up around cryptocurrencies is very exciting to watch, and especially around the non-fungible tokens. But more and more financial advisors are including cryptocurrencies as an investment alternative, as their clients are inquiring into it, with some super funds even using cryptocurrencies as investment instruments. How do you see the introduction of the anticipated Bitcoin ETFs and the emergence of central bank digital currencies to impact the existing investment ecosystem, please?
So I think central bank digital currencies will be, more directly used as actual currency. So for general buying and selling, there won't be there won't be a store of value. Bitcoin is more like digital gold. It's got the same sort of drivers as gold in terms of being a store of value and a risk mitigation tool. I think the ETFs could provide retail investors some exposure. Sophisticated investors understand that Bitcoin is a cryptocurrency, but DeFi and smart contracts, NFTs, as you mentioned, are not the same as cryptocurrencies. They're actually more like securities, the way that they trade. And they actually provide access to real underlying business cases, whether it's decentralized exchanges and so forth, insurance products, collateralized debt solutions. So that's where, Bitcoin is Bitcoin, and it'll be there. It's kind of what we call the gateway drug to the space. And you should have a small allocation to it. But I think the real opportunity lies in these sort of almost exponential applications you can build on top of the blockchain. It's like the internet is a thin protocol. And what was built on top of that, the likes of Facebook and Amazon and Google and so on, that's where the money was really made. And in the same space, in the same instance here, blockchain is a thin protocol. It's just a way of accounting. It's a decentralized ledger for transactions. And what's going to be built on top of that is where there's going to be amazing opportunities in disintermediation. So I think there's definitely a place for holding some cryptocurrency directly yourself. And there's a place for if you want to go out and find funds, if you're interested in spending a lot of time doing the research and you're comfortable with the risk. And then there's a solution, what we offer, which is kind of a set and forget. It's a very simple, plain vanilla approach to the investment side. And we take care of the operational risk, the custody risk, the vetting of the fund managers. And we build a portfolio that gives you upside exposure, but you're never going to keep up with the market because you've got hedges in place. But then it protects you. When the market dropped almost 50%, in May this year, we were down 8%. So, that's kind of what you're looking for. We give you a much more palatable ride into the crypto space rather than sort of riding a psychotic horse through a burning barn.
Yes, the white-knuckled roller coaster ride, which it's known for usually. So that sounds like a brilliant suspension there. Now, we're running out of time, but would you like to add any comments as we close up here about how cryptocurrencies correlate with inflation? And we seem to be heading into a backdrop of high inflation. How do you think it's going to progress in the coming months?
So our base case is that inflation is going to turn very, very quickly once the velocity of money picks up. There's been a lot of printing of money, but the velocity of money, how fast money moves around an economy, has been really flattened as supply chains globally have been disrupted. But that's starting to turn, and we're seeing asset price inflation in real assets, real estate, collectibles, and so on. So I think crypto has benefited from that. It is seen as a hedge and a store of value. And I think that going forward, as fiat currencies start to become debased, which you're seeing a lot with the dollar already, and now 140 it was a lot lower 6 months ago and a lot lower 2 years ago. I think you're going to see, a real shift from potential fiat currencies into the digital asset space. Central bank digital currencies are going to just be, I think, more for transactional and for, continuing trade globally, and for government to keep tabs on where its spending is going, which is a good thing. But it's not going to compete directly with the digital currency space, which I think will benefit a lot from the coming inflation.
Great. Well, thank you so much for making time for us today and sharing your insights on working in the digital assets and blockchain area. We'll have to wrap it up there. I'm so excited by what the blockchain is doing for renewable energies and energy in general, and hopefully it will add more liquidity to the market. So an exciting space to watch. Thanks so much again for making time for us today, Derek and Mark. I'm sure your valuable insights have been enjoyed by our viewers.
Thank you for having us.
Thank you.